Welcome to this presentation on foreign currency trading. Here we'll cover rudimentary details and many aspects of currency trading, which is said to have the highest trading value among all the financial assets. Now, forex trading is said to be the act of buying and selling currencies in the stock exchanges. Here we'll examine the following factors affecting the currency exchange rate. Understanding currency pairs, the fundamental factors affecting exchange rate, working of the future and the forward market, the role of interest rate parity theory in determining the future valuation, the currency market working in India, the liquidity position of various currency pairs in India, the futures rates curve of currency pairs in India, the currency options markets in India. I am Aninda Datta, the presenter. Now, what is currency pair? Forex trading involves speculating on value of one currency against another. Forex trading involves trading currency pairs such as Euro USD, GBP by JPY, USD by INR, or Euro by INR. The first currency in the pair is called base currency, and the second is called quote currency. The exchange rate represents the value of the base currency in terms of the quote currency. In the futures market, a long euro by USD at 0.9 means buying 0.9 units of euro and selling 1 unit of USD. Similarly, in the futures market, short euro USD at 0.9 means selling 0.9 units of euro and buying 1 unit of USD. Exchange rates are affected by many factors, and those factors could be classified under the following heads. Economic data like GDP growth, inflation, interest rates, etc. Central bank policies like monetary policy action, quantitative easing, tightening, market intervention, etc. Political situation, example, a stable government following fiscal discipline keeps the exchange rate steady. Liquidity, the various liquidity measures taken by the central bank like SLR, CRR ratios for the banking sector, or indulging in open market operations by the central banks to control the liquidity. Now let's examine the various economic factors that affect the cross-currency exchange rates. The identified factors are differential interest rate, differential inflation rate, current account deficit, central bank action, and foreign currency debt. Foreign currency debt and public debt level. Increase in foreign currency debt leads to currency devaluation, and the fall in the same leads to currency appreciation. Any quantitative easing by the central bank increases the money supply and causes devaluation in the exchange rate, whereas a quantitative tightening by central banks causes the money supply to shrink, leading to currency appreciation. Differential interest rate. The inflation interest rate and exchange rate are generally interlinked. As the central bank changes the policy interest to change the inflation rate, the differential interest rate impacts the currency exchange rate, as higher interest rate attracts foreign capital, which pushes up the exchange rate. Differential inflation rates. The country with lower inflation rate experiences higher currency value, as its purchasing power is maintained relative to the other currency. However, countries with higher inflation usually have higher interest rates, which in turn attract foreign capital inflow. Current account deficit and balance of payments. Countries with high current account deficits and balance of payment deficits suffer currency devaluation over medium to long term, whereas countries with current account surplus and balance of payment surpluses experience currency appreciation. However, this list is an illustrative list and not an exhaustive one, as many other economic factors impact the currency rate in a small manner. Now let's examine how the currency trading mechanism works. The currency trading in stock market happens through two routes, futures and options. Here in this presentation, we'll be covering the futures routes. A currency futures contract is a contract to exchange a currency for another at a fixed rate on a specific date in the future. The contracts are standardized and traded on the central exchanges. The future price of a currency is different from the spot price. The difference is the interest rate differential between the two currencies given by the interest rate parity formula. Interest rate parity is a theory according to which the interest rate differential between the two countries is equal to the differential between the forward exchange rate and the spot exchange rate. Now this gives the interest rate parity formula. Here you can see the difference between the two interest rates, that is the interest rate differential between the two currencies is reflected in the forward exchange rate. That is the forward exchange rate by spot exchange rate is equal to that interest rate differential. Interest rate parity theory broadly defines the difference between the spot and the exchange rate. However, it does not perfectly explain the difference as many other factors influence the futures rate. The violation of interest rate parity creates a risk-free arbitrage opportunity in the trade. Now let's examine how the currency derivatives market in India operates. In India, the currency derivatives are traded in the National Stock Exchange. The following four currency pairs are traded in India: USD INR, Euro INR, GBP INR, JPY INR. However, the substantial liquidity is available only in USD INR to enable bulk trade. Now let's examine the liquidity positions of four currency pairs in NSE by two liquidity metrics, that is bid-ask spread and open interest. The data is taken as on 19 June. This table gives the bid-ask spread of four currency pairs on two dates, that is 26 June and 29 July. The table and chart show the bid-ask spread for the four currency pairs for two different future date contracts. As could be seen, the bid-ask spread is US dollar INR is much less than the other three currency pairs. Lower the bid-ask spread, higher is the liquidity. As could be seen, the bid-ask spread is by far the lowest in USD INR, so that is the most liquid pair. Yes, see the USD INR's bid-ask spread, total of bid-ask spread for the two contracts is way lower than the bid-ask spread for Euro and JPY. Only in GBP INR it's somehow comparable to the, it could be compared to the USD INR. Now let's examine the liquidity position of currency futures market in India. And liquidity is present in ample quantity only in USD INR. We'll evaluate the liquidity through the matrix futures open interest. The tables and graphs below show the open interest of four currency pairs for two different futures contracts. The table shows the currency pairs open interest for the two position. As could be seen, the USD INR's the open interest position is much higher than that of other three. Now let's examine through the pie chart. USD INR's open interest comprises 99% of the total open interest as on 26 June's futures contract. Three other currency pairs comprise the remaining 1%. Similarly, for the 29th July, the 99% of that is the 98% comprises USD INR, and the remaining 2% comprises the other three pairs. It could be seen that 99% of total open interest for both the futures contract are in USD INR. So there is sufficient liquidity only in USD INR to enable bulk transactions. Now let's see what is the shape of the future price curve of the four currency pairs. The future price curve of four currency pairs follow a contango. As interest rate in India is higher than the rate in four other countries, that is US, Japan, European Union and GBR, so the futures curve follows an upward slope called contango. As time passes and the expiration date approaches, the future price converges to the spot. Suppose the spot price remains constant during the tenure of the futures contract, then the buyer of futures contract incurs loss on contract expiry as the future price falls to the spot price level. This process is called negative cost of carry. So buyers of all currency futures contracts in NSE suffer negative cost of carry if the spot price remains constant. As this chart shows the future price of various currency pairs on future dates, and the top row shows the expiration date of the futures contract. As could be seen, only USD INR have quotes till 29th October, as that is the most liquid pair. This shows the shape of the futures price, which is upward sloping, that is follows the contango for the USD INR pair. And now let's examine the imperfections in the upward sloping future price curves of the currency pairs. It's a graphical and tabular representation of the futures premium. As could be seen, the Japanese INR curve has the highest upward slope, as the interest rate differential between JPY and INR is the highest. This is the annualized future price premium, that is the future price premium has been annualized, and this shows 1.3% for the USD INR for the 29 July contract. And it is highest for JPY INR, as interest rate differential between Japan and India is the highest, as depicted in this curve. As currency pairs other than USD INR have very low liquidity, so quotes are available only for 1 month. As we are looking at 1 month futures, that is extreme near-term yield curve interest rate differential, so the policy rate difference could be considered for the rate differential calculation. In India, the policy rate is 6.5%, US have 5%, EU has 4.45%, and JPY is 0. Thus, the policy rate differences are reflected in the annualized future exchange rate differences as per the interest rate parity. India and Japan have maximum interest rate differential, so the future curve has the highest upward slope. However, the future premium is generally not exactly equal to the interest rate differential, as many other fundamental and technical factors influence forward premium. Now let's examine the various takeaway points from this presentation on foreign currency markets in India. The forex market especially has lower volatility than other assets traded in the financial markets. So the same amount of margin allows trade in higher notional value of the contract. The volatility of a currency mainly depends on uncertainty / certainty about its future interest rate and the short-term liquidity factors. In India, the central bank also frequently intervenes in the forex market to control the USD INR volatility. The USD INR has a small positive correlation with the global USD index, as INR is affected more by local factors like oil price, trade deficit, and inflation. In NSE, one can do volatility trading in USD INR options, but we'll cover that area in the next video. So in this presentation, we got a broad idea about the overall forex market scenario and the forex market in India. In the next video, we'll see how to do directional trade in currency using futures and in some cases using the options. So this concludes this presentation. Thanks for watching. Please watch the next presentation also, as that will be the continuation of this presentation.